think that's unique. And I mention it because it is, I think, profoundly negative in one respect. And obviously all these assets are now cheaper apart from the two at the top. But I think what's interesting about it is it shows the correlation between asset classes. It shows that it's pretty difficult to find somewhere to hide. When things go wrong. And things did go wrong for some of the reasons I mentioned in 2018, and it was very difficult for investors to protect themselves. So that is, it shows that things aren't back to normal, which I think is something to be aware of. I also still worry about the political mood, not just in this country, but also in developed markets generally. I think that clearly the global financial crisis and the response to it has had a number of effects. I think one of the most significant is that wages have barely grown in 10 years, or more than 10 years. You've also got greater inequality in income and wealth as a result of financial repression, cheap money. And you now have, in a lot of countries, obviously here we have the prospect of a Marxist government. There's been a great strengthening of hard-left populist movements now in places like Italy, France, even the US. And anti-business policy now is becoming more popular. That is definitely a potential negative, not just here, but in many other places. And the concern is that globalization, and I think also the growth of big technology companies, which employ very few people, relatively, these have created issues which capitalism hasn't yet found an answer for. And if it doesn't, politicians will try. And the impact, I think, would be quite significant, both in terms of margins for companies and also in terms of tax rates. So both of those things are potential negatives, not so much today, but over a period of time, that need to be borne in mind. I mentioned the yield curve last year, which was pretty flat. Last week it inverted, and that has traditionally, well, in the last 60 years in America, an inverted yield curve has always preceded a recession. So it is definitely a red flag. It's not totally predictive. It doesn't mean there will be a recession. The lead time is typically 18 months, so it's not an immediate thing. But it is something to bear in mind. It hasn't been confirmed yet by credit markets. Credit spreads haven't reacted at all. But I think it is certainly something to bear in mind over the coming months to see how that behaves. And on the subject of credit markets, this is interesting because credit markets really have only got worse since the global financial crisis, which is very perverse. Excess debt created the problem, and the response, somehow or other, has been to create a lot more debt. And there are some slides here I'll just show you. So this is the graph of US corporate, this is investment grade, the blue line is investment grade US corporate bonds, and how the number in issue have grown. You'll see in 2007, there were $4.25 trillion of investment grade corporate bonds. That represented 29% of GDP in America. That number's grown to $7.5 trillion nearly, and 38% of GDP. Now, what's particularly relevant about these particular bonds is an awful lot of them, in many people's view, are not necessarily investment grade. So they achieve the investment grade rating, but on a lot of measures, they don't really deserve it. And just looking at leverage ratios by themselves, you could make a case for a very significant proportion of these bonds actually being recategorized as junk. Now, why that's significant is a lot of investors in bonds can't buy junk. And so you could easily have a scenario with a small number of downgrades where 100, 150% is added to the volume of junk bonds in a very short period of time, which would swamp the market because there wouldn't be buyers for them. This really first occurred to people when GE got in trouble. GE has about 100 billion, just over 100 billion of debt in bonds, and it wouldn't take much for some of these chickens to come home to roost. This shows it a different way. And the sort of bluey-grey line, the bluey-grey section, shows the growth since the crisis of bonds that are rated one rung above junk. So there's been an explosion in that category. Again, that worries me. And just while I'm on the subject of debt, there's a lot of it around. These just show the growth. The red line is 2007, and the kind of light blue line is now. And you can see that non-corporate financials, non-financial corporate companies, their debt's grown from 42 to 68 trillion since the crisis. Government debt has doubled from 33 to 63 trillion. Financial company debt has grown from 53 to 58, maybe relatively well behaved. And household debt has grown from 34 to 44 trillion. Now, in relation to GDP, these numbers are big. So today, total debt globally is $233 trillion, which is 318% of global GDP. These are big numbers. And my point is, the problem not only has it not gone away, it's got bigger. And the last thing on debt, you may not be able to see this, again, it doesn't matter too much, is this is central bank balance sheets. And central bank balance sheets now total nearly 20 trillion. And the middle on the left hand side is the Federal Reserve balance sheet. And you can see there, it's the only one that's really tried to reduce its balance sheet. And we know what happened when they tried that last year. It wasn't a very nice experience for anybody. So these problems have not gone away, and I think it's incredibly important to be aware that they're still there. So just to conclude in terms of where we are market-wise, I would say that I remain very concerned about the potential normalisation of monetary policy. When it normalises, it will be severely testing. I don't think it can normalise for quite a long time, but that problem is not going to go away by itself. One day it has to be faced. I think margins are very high and have probably peaked for most companies, and there are threats to margins, which I touched on a minute ago. Cash, for a long time, has been a dirty word. Investors haven't liked cash, and corporates haven't liked cash for a very long time, mainly because debt's been basically free or very cheap, and you can use it to increase returns almost with no consequences. My view is that's probably beginning to change now. We've had rates go up a fair bit in the States, and there's been a little bit of, I've noticed a small change in behaviour in the UK as well, where companies are beginning to hear from investors they've got too much debt. You didn't hear that a year ago, you haven't heard that for a very long time. So I think that it is possible that debt could start to become a dirty word in the way that cash has been for a long time. Now, having said all that, as I said right to start with, what matters most to me is valuation, and that is the single most important determinant of returns. And my view is that valuations are significantly better than where they were a year ago, and indeed better than where they've been for quite a number of years. So I'm more comfortable focusing on valuation and the earnings prospects of companies I'm interested in. And based on those, I'm happier right now to be in the market rather than out of it. I do think all these problems are still there, and one has to be wary. Certainly we're no longer in a period where one can be a rampant bull, but I do think the risk is in favour of being invested at the moment. Now, I don't think this is that old, this joke, but I'll tell you, because it's relevant to this point. And it's a story about a Scotsman who's incredibly mean, a man called Robert McTavish. And he's in great financial difficulty as well. And he's quite a religious man. He goes to the church and he prays to God, saying that I desperately need to win the lottery. My wife's going to leave me, we can barely afford to feed the children, I'm worried about my job, I can't afford to keep the house, there are major problems. Please help me win the lottery. He doesn't. So he goes back the following week, prays again. He says, God, my wife's now left me, she's living with her parents. terrible trouble. Please help me win the lottery. He doesn't. He goes back to church the following week. He says, God, I've now lost my job. I'm about to lose the house. My life's going to fall apart. I'm living on the streets. I don't know how I'm going to go. Please help me win the lottery. And a voice comes from the top of the church. It says, McTavish, meet me halfway. Buy a lottery ticket. So if you want a return, you do have to be invested in some way, and certainly with the lottery. Anyway, so I'll move on now to more practical matters. And I touched on this last year, but I think it's incredibly important. I think to invest well, you have to have a method. You need some sort of intellectual framework for what you're doing, an intellectual backbone, if you like, for what you're doing. And I think it enables you to handle difficult market conditions like we saw in the fourth quarter better than if you haven't got that framework. My preference remains, and has done for many years, to focus on growth companies, looking to buy them relatively cheaply. So one's looking for consistent growth, one's also looking for an above average growth, one's looking to buy that growth on relatively low multiples of earnings, and the best way of comparing the two is using the PEG. And then making sure that the companies generate cash. I think cash is interesting in two ways. You want companies that generate free cash flow, i.e. I typically avoid very capital consumptive companies. And you also want profits to be converted into cash. And the gentlemen who were talking earlier, I think all of them would agree that very strong levels of cash conversion, profit being turned into cash, is a very, very positive sign in relation to accounting, jiggery pokery, and all the rest of it. If the company's turning profits into cash, then the odds are things are pretty much as they're meant to be. Those sorts of screens, those pretty simple screens, properly applied, you can eliminate 95% of the investment universe pretty rapidly, and focus then on the remaining 5%, which at least on the face of it are likely to be interesting. They're worth consideration. And what we do is we screen totally quantitatively initially, and then once we've got our short list, we're entirely qualitative. And the qualitative piece is also incredibly important. And what one wants to be focusing on, ideally, are businesses with high returns on capital, businesses with interesting and strong business dynamics, ideally businesses that are relatively simple to understand. And another key point is if one finds a good business at a good price, or even a fair price, one needs to hold them for a reasonably long period. They're relatively rare. You don't sell them unless they're significantly overpriced, or at least reasonably overpriced. Now, buying a business on a low peg gives you two forms of upside. You have upside from earnings growth, and you also have upside from an eventual re-rating of the PE multiple. It's a very attractive double whammy. Similarly, the qualitative piece, the qualitative side of things, gives you the scope for a business to compound year after year after year, and that's where the big money is. One important question when you're doing your analysis, I think, is to ask the question, is this business facing disruption? That's a much more important question than it's been for many, many years. In other words, does this business face a technological or competitive headwind, or does it benefit from a tailwind? At the very least, is the business trying to innovate in some way or other? I think now more than ever, you need to be on the right side of change, which is happening relatively rapidly. And if you forget all those things, one thing by itself is very important, which is don't get in the way of Amazon. Amazon always wins. I don't know why, but it just seems to. So businesses that are trying to take on Amazon always lose. Last time I illustrated this point with two examples, and I'll just give you an update on them because it's quite revealing. First example was a company. You can sit on this. It's a company called Next 15. Next 15 is a company we've owned for roughly 10 years. It's an interesting business. It's done very well for us, and it's a tech-focused marketing business, and they've been very effective in aligning themselves with a large proportion of tech customers. They've built an interesting platform where they're able to bolt on acquisitions and squeeze out quite significant synergies that other people would find difficult to squeeze out. And they're relatively innovative in what they do. And I compared them last year with WPP, which is a slightly lighter line underneath. And from the 1st of December 2017 to 30th of April last year, there was already quite a big disparity between the two. Next 15 had risen 24%, and WPP had fallen 3% over that time. And I just thought it would be good to update on this because it is interesting. So the line, the sort of straight line, is kind of where we were last year. And that trend has continued and accelerated. So now over the whole period, Next 15 is now up 45%, and WPP, where quite a lot of chickens came home to roost last year, is down 38%. Now, it's a very significant difference between the two, and the opportunity cost of buying WPP as opposed to Next 15 in this whole period is 134%. Very significant. I also gave another example, which was a company called On the Beach, which is an online holiday business, very effective marketing machine, which is relentlessly taking market share from the traditional holiday companies, which I use here TUI and Thomas Cook. Now, in the period I touched on last time, On the Beach was up 34%, TUI was up 22%, and Thomas Cook was up 6%. And since then, it's been a very tough place to be in this industry, actually, in the last year or so. So since then, if you look at the whole period from the beginning, On the Beach has given up its gains, and it's now down 4% for the whole period. But TUI is down 46%, and Thomas Cook is down 78%. And that, to my mind, clearly there have been other factors involved. I mean, this has become a much tougher space, a number of things have happened. But the disruptor has been much, much better insulated than the companies it's disrupting. I think disruption comes in many forms, but you can boil it down into two broad categories, I think. The first is the rise of the platform tech companies. They've got massive marketing power, huge network effects which they benefit from. They've got, they've massively increased marketing costs for other companies, and they've also created much greater expectations amongst consumers. All of those things create difficulties for other companies. I think the other broad category is the changing consumer psychographic, and in particular the millennial psychographic. And as a result of those two phenomena, competitive advantage has changed. Now, we've seen this most dramatically in the retail space, where there's been and it's not just because of these two things, but we've seen a totally different landscape, really wholesale destruction in the retail sector in the last few years. And it's really coming to a sort of boiling point now. But you also see it in, for instance, with brands. You know, a lot of big brands that used to be incredibly resilient are no longer as popular as they were. They no longer have the power they used to have. Very significant change. Now, I think, so as a result of this, a company's competitive advantage, competitive position, is more important than ever. And it's also important, I think, to try and find businesses that can really make their own weather, that can, it might be because they have a strong technology proposition, very powerful IP. Another category which I talked about last time are companies that can roll up competitors. Though now, roll-ups, acquisition-driven models are not normally by themselves. Often one has to be quite wary of acquisition-driven businesses. But when a business creates a platform which enables it to squeeze out efficiencies other people can't squeeze out, and it's in a good growing area as well, then very often good things happen. So that is also an area that interests me. Last time I mentioned a number of companies like that. And I'll just touch on one, which I think in the last couple of years has really exemplified what I'm talking about. Now, this isn't a recommendation in the sense that it's done very well, particularly in the last 6 months, so you wouldn't be getting it at its cheapest moment. But it's a very good illustration. This is a company called Future Group. It's a company that's had a rather strange history. It's been public on and off. It's been owned by Pearson at one point. It's been owned, I think, by somebody else. It started off as a sort of hobby publishing business, it, with the rise of the internet and a number of other things happening, it lost its way. But they've really got a fantastic proposition now. They have very strong content, very strong, very niche content, and they're very, very good. Well, to rank well in Google search rankings, the better your content, the more likely you are to rank well. I mean, strong content is probably the most important determinant of that. But they've got very good content, but more importantly, they've got a very strong proprietary technology stack that enables them to monetize it. Really in two forms. They've got a real-time bidding platform which enables them to effectively auction their inventory of content in a way that maximizes price with advertisers. And they have a proprietary website technology that enables them to tag content automatically. So, for instance, if they wrote an article about the latest iPhone, and you read that article and went on to buy it, you would end up paying a commission, which they could track. And it was very interesting the other day, they were saying that on Black Friday, particularly in the States now, also here, is a very important retail event. On the Google rankings, search rankings, they beat Walmart on the search for best Walmart deals. So they actually effectively stole Walmart's clothes, really through good content and effective technology. And what we've seen recently is the business beginning to see very significant growth in this relatively new area for them of e-commerce sales, where they're taking commissions on sales. And the company now has a wonderful sort of sausage machine where it can buy content and monetize it much, much, much more efficiently than its previous owners. So there's huge accretion. They're not just playing the earnings game by buying companies using debt or using cash. They are squeezing enormous, much, much more than anyone else can out of content. So the other day, about 3 weeks ago, they did another deal, and not a huge deal, and that resulted in a 19% earnings uplift just based on that deal. As I said, it's a very interesting business. The shares are not super cheap at the moment. They've had a good run lately, as I said. But today the shares are on about 22 times earnings to September 2020. That assumes no more acquisitions, and of course there will be more. But comparing with a growth rate of around 40% the last 2 years, I don't think necessarily valuation at all. Now, I'm talking about how important it is to do your homework, and I have a little story in relation to that too, which is this is in the Me Too era. This is slightly risky, but it was told to me by a man of the cloth, so I had some sort of air cover. But it was a story about a priest who's driving a nun back to her convent, and she's incredibly attractive. Not that should matter to this priest, but he noticed. And he's driving along, and he's driving a manual car, and whenever he shifts gear, he came up to a set of traffic lights, and he shifted gear, and he just brushed her knee as he shifted gear. She said, Father, Luke 14:10. He said, I'm very, very sorry. He came up to another set of lights, and he brushed her knee a little bit higher up the leg, and she said, Father, Luke 14:10. He said, I'm really sorry, I'm forgetting myself, I'm so sorry, I can't apologise more. So, he drops her off at the common, and he goes home, he gets his Bible out quickly, and he looks up Luke 14:10. It says, friend, move up higher. So, it actually does say that.